Welcome in, folks. It's a buy one, get three free in this one. 4 videos up here for me to react to. First one is my number one stock, Meta, is in trouble here. Okay, EU's launching an investigation into Meta. Not only Meta, it's also Apple and Google McDougal as well. So we're going to get into that, talk about the ramifications, what that means for Meta stock overall. Investors are worrying about Fed rate cuts under a different economic backdrop now. I think that's going to be an interesting one to react to. Then we're going to react to this little 4-minute clip. Recent S&P 500 target boosts are unsettling. Okay, where are we going with that one? And then at the very end, Ed Yardeni is going to talk about why the S&P 500 is 6,000 next year, which I think should be a very interesting subject to get into. So appreciate you guys joining me as always. I'll ask in return, smash that thumbs up button. Make sure you do it. And also make sure you're subscribed here to the channel. If you're not, we are well over 42,000 subscribers. I think we're on the path to 43,000 subscribers. So I appreciate each and every one of you. If you're looking to apply to join my private group, get access to all my premium courses that teach you everything I know up here in relation to stock picking, running portfolios, be part of our 6- and 7-figure Discord chat, all that sort of stuff, then check out the pinned comment down there, click on that, and you can go ahead and fill out an application and join us in there. Okay, all right, guys, let's get into this.
Look at what that might mean for big tech and Google in particular in today's Tech Check. Hey, Dee.
Hey, good morning, Carl. So past crackdowns on big tech in Europe, that's mostly amounted to speeding tickets or minor slaps on the wrist. We know this. But the Digital Markets Act, the DMA, it's different. That is why we may be seeing more stock reaction this time. You can see Alphabet and Google and Meta, Alphabet, which is Google, Apple, Meta, all down today. Now, the DMA is essentially European regulators going on the offense, identifying the so-called gatekeepers, laying out rules to try and prevent their future abuse of market power. The penalties also have more muster, and it puts breakups on the table, which would be incredibly difficult, but we wanted to take a look at where it might be less hard for some mega caps than others. Apple, for example, more closed ecosystem or walled garden than, say, Google, but also far more highly integrated. So how would it actually divest its app store? It's more complicated. It's also been less aggressive on the M&A front. Google, on the other hand, arguably less integrated. A breakup order could target separate businesses like cloud or past acquisitions. Its purchase of DoubleClick back in 2007 that complemented its core strengths in search ads, helped cement its dominance in online advertising versus like a Beats at Apple, which sort of made a difference around the edges. For now, at least, though, the street in Silicon Valley seem less interested in how the European regulators could impact Google's current business. They're more interested in a recent development that I wanted to talk about. Last week, Google began testing its generative AI.
Okay, before we go any further here, okay, this EU situation, what is the risk to Meta specifically, okay? To Meta specifically, I think there's a risk there, right? There's a risk, a fine potentially. I don't know what they're going to do. Okay, so there's some level of risk. We got to talk about that, right? But on the flip side, everybody's been all into Meta's business for years now. Okay, I mean, they were the ones that got it way before anybody else got it in terms of everybody looking into their business. What are you guys doing here? And because it's such a powerful company that so many people in the world use, I mean, 3 billion plus monthly active users is insane, right? And on top of that, there's stuff that happened in past elections and all those sorts of things that people thought, certain things were being manipulated. So in regards to Meta, this is nothing new to them. I think they've been through this stuff more than anybody out there, right? So I feel the most comfortable in them handling this than others that I feel like Apple, for instance, has just started to go through this stuff very recently. And, now the DOJ is going after Apple. So that's like a newer risk to Apple, whereas it's kind of like this is old news. I mean, Meta's been going through this for, on and off for 5+ years now at this point in time. But there's still a level of risk. You never know what they could do or potentially not do, right? You never know if they could get slapped with some $3 billion, $5 billion, $10 billion fine. Those are all risks.
In the main Google search interface, I'm told that it was a very limited test and a small number of queries, but it's ongoing. Morgan Stanley writes it could suggest a broader rollout sooner than expected, despite that innovator's dilemma concern. That's what we've talked about a lot over the last months, the idea that it would have to sort of disrupt search in order to get ahead in Gen AI. The key part of that rollout, it continues to serve ads on the result pages, even within that Gen AI proposition. So that does ease some of the concerns that Google isn't monetizing it or moving aggressively enough. This is, guys, Gen AI in the wild, which a lot of the street has been asking for with ads. So can Google have its cake and eat it too? I mean, that's the question. And over the last few weeks, there's been some evidence that it may be able to do that.
We'll see. We'll see. Okay. Alrighty. Next one up here. Investors are worrying about Fed rate cuts under a different economic backdrop.
A week ahead and beyond is Lori Calvasina. She is RBC Capital Markets head of U.S. strategy. And Lori, we have seen the markets really have a pretty phenomenal year to this point. I think the S&P has already set 20 new highs before we even reach the end of the first quarter. You're looking at all of this, and your target for the S&P 500 is below where it stands right now.
Yeah, and look, I think this is one of those moments, right, where we're taking in a lot of information and digesting some conflicting crosscurrents is how I put it. So I think if you want one stat that just sort of explains why it's been such a good year and why it could continue to get even better, just look at GDP forecasts. So a consensus is right now looking for about 2.1% this year. And to start the year, it was closer to 1. As recently as mid-February, it was about 1.6. Last summer, it was 0.6. So this whole idea that we're on the brink of recession, that's just been brushed aside. And now the debate is, how hot is the economy? And one of the most common, sort of worry points I hear from investors over the last month or so has been, is the U.S. economy so hot the Fed can't possibly cut? It is a mirror.
It's such a weird worry, right?
Yeah.
Think about things.
And it's so weird if you think back to last August when people were like, well, the Fed
Listen. Hold your horses, okay? That's not a weird worry at all. That's a legit worry about the economy being potentially, let's call it, in too hot of a place where inflation's too embedded in the economy, right? And unemployment's in such a low place that it's causing wage pressure, and you're in a wage price spiral, and companies have to keep going up on wages, but then at the same time they have to keep going up on prices, which keeps inflation higher for longer, which means interest rates have to stay higher for longer, which means you could have a more substantial crash down the road, right? The longer rates are in a higher place, right? That's the worry. And we'll see if it works out that way, but that's the worry. So, I don't think it's a weird worry at all, in my personal opinion. I think it's a legit worry, and I understand why people had that concern. Just the problem is trying to predict when it's going to happen, right?
Inflation's going to be sticky, and they're going to drive us right into a recession. So it's the same worry. The Fed's not going to cut, but it's just the complete opposite in terms of the economic setup.
Okay, so this weird crosscurrents, I think about all the people that are trying to figure this out right now. The Fed's facing the same problem.
Right.
Do we cut rates? Do we stand pat? A few months ago, or even a month ago, we were asking if they'd have to raise rates because inflation has been hotter than expected. Goldman Sachs has kind of a weird way of dealing with this today. I think they're sticking with their S&P target of 5,200 for the year end. But they've got another group of analysts led by David Costin, who's saying there is a chance that big tech is going to take this all the way, the S&P 500 all the way, another 15% higher to 6,000. So how do you do that? How do you kind of, as somebody who's responsible for saying where the markets are going to be at the end of the year, how do you figure it all out?
So the way a lot of us do it, we'll say this is our base case, this is the bull case, this is the bear case. And, I will say even within our own modeling, we have this one valuation model, and we run all kinds of stress tests on it. If I just take current consensus projections, it points to 5,400 on the S&P at the end of the year. If you use my earnings number, if you use consensus, it's 5,700. Now, I actually don't really believe those consensus estimates right now, so I ran a new stress test where I kind of softened them a bit, basically reflect what's in the Fed SEP. I point you to about 5,300 on my earnings number and about 5,500 on consensus earnings. So I see a bull case that seems very, very reasonable to me. The problem is if you look at sentiment and how quickly, again, the markets have come. So the CFTC data on buy-side positioning is actually above levels we saw in early 2018, is above levels we saw in February 2020 pre-COVID, and it's above all the highs we've seen the past couple years. If you look at AAII net bulls, you're one standard deviation above the long-term average. And that's consistent with a short-term pullback in the market and kind of muted gains over the next 12 months. So yes, there's all this great news. Have we priced a lot of it in? Markets are funny. They often run hotter than they should, especially in recoveries. And we think this is kind of a weird recovery we're in. But you have to acknowledge the sentiment data is sending some pretty, sort of nasty signals right now. So as a strategist, we try to balance all of that, and sometimes it doesn't always line up perfectly. Usually the sentiment can get resolved pretty quickly, and then markets can kind of recover and march on, and that's kind of my assumption, right?
So how do you set up your portfolio to weather all these potential outcomes over this next 12, 18 months, right? Here's how you do it. You've got to have, first off, GVD. I talk about that strategy a lot in how I like to invest. Growth, value, dividends. Having a good portfolio of growth stocks, value stocks, dividend stocks. Now, when the market's running very hot, a lot of people get addicted to just buying growth stocks, and they're just like so in a growth mentality. They're not even thinking about the downside that will be coming eventually, right? And so they only buy growth stocks when you already have been like in a growth market, right? you got to always stay diversified. And when you're in a bad market, people get too focused on value stocks and dividend stocks only, right? Because they're thinking, oh my gosh, there's so much risk out there. When growth stocks are down 60, 70, 80%, that's actually an opportunity to go buy those stocks at that particular time. So in a bear market, people get too focused on value and divs. In a bull market, people get too focused on growth stocks. Don't matter what market you're in, focus on all three is my name of the game. The next thing to do is make sure if you're a higher net worth individual, make sure you have some hedging done. It's something I talk about in the private group a decent amount. I got some really good videos in there about hedging and different hedging strategies and things like that, right? So that's available. Keeping some cash around is always a good thing to have, especially right now. I mean, you can get 5% on your cash. You know, if you're in a great savings account or a high yield CD account right now, or treasuries, you can get 5% right now. So, I mean, that's not always like that, right? So it pays to have some cash around, because if you can get 5%, that's running obviously much above the 3.2% CPI is at right now. So those are just some ways that you can, it doesn't really matter what the market throws at you, right? And that's kind of how I think. It doesn't matter what the market throws at me, this, that. I'll be out on the other side and we'll be looking good. Like, it is what it is, right? And so, you know, EU wants to look at my biggest investment, and, you know, they've done that for a long time. Like, let's see, right? Position yourself for any
I'll tell you,
outcome.
Becky, I've been looking for a pullback for 3 months, and we haven't gotten it.
And you're not alone. I mean, I would say this is a really weird year, but then again, you could say that probably about every year. You think to 2019, nobody was predicting or expecting that we'd have a global pandemic that would shut down economies everywhere.
I think that's fair. And I'll tell you what's kind of made things make a little bit more sense in my head to me, and I've been talking about this a lot more. We wrote about it a bit this morning. I think we came pretty darn close to a recession in 2022. We had 2 negative GDP quarters. The stock market priced in a recession, had a similar drop. Consumer sentiment on the Michigan survey went to recession lows. Inflation spiked the misery index spiked because of inflation, not unemployment. And you kind of felt as bad as you typically do in a recession. So I think we're in this weird recovery that nobody understands because...
Okay, so that's crazy. We've already had the soft landing, essentially. We had the landing and we've taken off again?
I think we actually had like that W. Remember back in the pandemic, we were debating all the letters, and I think we kind of had like a baby...
I forgot about that until you just said that.
Yeah, but it was like this whole V-shaped recovery. Everyone, thought people were crazy for saying that, and we basically had that, but I think you kind of had like maybe a shallow, kind of other V on the other side of the W. And one thing about recoveries coming off of big crises, we tend to underestimate everything. People get PTSD and really just sort of underestimate earnings, underestimate the economy. And I think that's what we've done on the economy recently.
So forget about the base case. What do you think is most likely?
I think that we're going to have some choppiness at some point this year. I think we're going to have a little bit of a pullback, somewhere between 5 and 10%, maybe closer to 5 because everybody wants it.
That's not much of a pullback if you're an investor waiting to get in.
It's not. And, I think we're going to have some choppiness. I would say there are kind of 2 camps of strategists right now. There's the constructive camp and there's the sky is falling camp. And I'm definitely not in that latter.
Lori, what's your total? I remember when Trump was on, he said prices are up 50%. They're not up 50%, but they are up. I don't know what number you would use. Probably, I think 30 is probably about right.
Like inflation, or
when you have a couple of years, when you have a couple of years of much higher than expected, and then it slows to 3 or 4. You've still got the couple of years of much higher than, I just know from maybe it's the supermarket I go to, so it's so expensive, but I can feel it. I still feel it. And wages, have they caught up? I mean, are people now does their dollar go as far as it did 3 or 4 years ago?
Well, look, I think in terms of like food prices, right, and all the things that we're sort of confronted with on a daily basis. I mean, I have 2 small children, right, so I see this in terms of how much it costs to stock my refrigerator.
That's what I mean.
Yeah, I'm right there with you. And
gas prices, I mean, they're down, but
they're not great, but they're better. And I think you have had some wage catch up that has helped offset a lot of this. I think you have different consumers feeling things differently. So the low end, that's what we continue to see signs of a bit of a crack. If you read through like all the food companies, for example, right, or other consumer companies, they are more sensitive to short-term interest rates than high-end consumers are. High-end consumers have done all the same things, right, that companies have done, termed out their debts, locked in low mortgage rates. So they're able to offset some of these things like higher grocery prices a little bit better than the lower end. But people are feeling it.
Yeah, 100%. No doubt. And I mean, you think about just how much rents and mortgages went up, and especially in a lot of the big markets where people actually live, right? You know, it was up more than 30% from 2019. I think so. I mean, if you went around a lot of markets and you talked about the same exact house, or, you know, to buy or to rent, the cost has easily gone up more than 30%, especially if you're talking about buying and you're talking about mortgage rates now versus 2019, and then how much more expensive that house is, plus the interest rates on top of it. It's not even close to 30%. It's way above that. I would say, you know, you're probably closer to 50 to 75% in a lot of markets, right? And so, yeah, I think that's some food for thought in regards to that. And then obviously inflation, as everybody knows, the lower income you are, usually the more you get hit. The middle class is really the one that gets hit the most, I think, always in regards to inflation, right? Folks that make, you know, $40,000 to $80,000 a year, I think is always the segment that gets hit the hardest whenever you're talking about inflation specific. Recent S&P price target boosts are unsettling. What?
There's a possibility for the S&P to hit 6,000 this year on the back of mega cap tech?
I think that's part of the euphoria that we're talking about, and no bang on any of the analysts, but all these analysts, after this near 10% move higher in the S&P 500 year to date, are reconfiguring their price targets. As money managers and asset managers like myself, we don't move our price targets. So 5,300 has been a price target, and we're almost there. So I think at this moment in time, Frank, I've seen a lot of people move their price target. That makes me a little unsettled, and that seems to be part of the cash narrative on the sideline chasing this market higher.
All right, so you're feeling just a little bit unsettled right now. I want to get a sense of how you see the trading day ahead. What's your WEX word of the day?
Well, my WEX word of the day is dubious. And as you know, that Latin origin dubious means to be doubtful and to question. And where I'm questioning the market, it's not the AI theme. It's not the move higher. It's not this parabolic melt up. I am questioning the Fed. And I think Fed President Bostic is going to talk about this potential rate cut this year of just one. That's where I'm questioning. And the word of the day, dubious, really relates to the fact that I don't think the Fed can pull off 3 rate cuts in 2024 when we see the inflation target that they are targeting of 2% not being achieved.
So I want to be clear. Is the idea that we might only get 1 rate cut, the Bostic forecast right there, is that creating some doubts in your mind about the future path of the market?
I think a lot of money managers out there are embracing the Bostic view, but the lens that the market is currently looking through is that we're still going to get 3 rate cuts. But it's very interesting, and there's some conflicting components out there with the VIX at the 12-13 level, the 10-year note's still about 4.25. It seems like the market is hopeful that we're going to get 3 rate cuts, but it doesn't seem like that rubber may meet the road. And that's where you could see a potential pullback, a healthy pullback, Frank, because it's been 100 days since the S&P 500 has not had a 2% pullback. So I think it'd be very healthy to see it come back and fill down to 49.50 in the S&P 500. And I think you'll see a lot of the cash on the sideline buy that shallow pullback.
All right. I want to get some of your moves you're making right now. These are moves that you advise other people to make today. You're actually reducing in mega cap tech right now. 2 chip makers we've been talking quite a bit about, NVIDIA and AMD, and also in Meta. Why reduce now?
Ooh. I think you have to look at the high flyers, and we've been long all these names. And in addition, we've been long SOX, SOXX. That's the ETF that gives you exposure to the semiconductors. But if you look at SOX in itself, 25% of that portfolio is exposed to these top 3 names, in NVIDIA, Broadcom, and AMD. So we want to reduce exposure. We still want to be long this AI theme. We're not walking away from the AI theme for 2024, but you have to look at some of the laggards. I think if you look at IBM, if you look at Intel, and last but not least, Tesla. Kathy Wood talked about this being the best play for AI. I agree with that. So all we're doing here is reducing exposure to some of our high-flying winners and buying some of the laggards. That makes sense at this moment in time to reposition portfolios. That's how you have the ability to capture a potential pullback or some profit taking in those high-flying names.
Yes, sir.
Okay, so my opinion on that is I don't love the strategy. I like the strategy of buying some beaten down dogs, whether that's a Tesla or some other companies. I like that part of it. I don't like necessarily the part of, like, you know, selling an NVIDIA or Meta or stocks like that, because at the end of the day, I mean, you really look at NVIDIA or Meta and you can make a very strong arguments that those stocks are incredibly undervalued. And honestly, I can make strong arguments that they're actually more undervalued than Tesla right now, right? Based upon future growth, based upon many different factors. So I'm not in love with that. I can understand maybe selling a Meta to put it in an NVIDIA or something like that, right? If you think NVIDIA has a better risk-reward profile over the coming years, but to sell out of those, to buy weaker stocks, I don't know. Like, I'm not the biggest fan of that. Just because a stock's been doing good does not mean it's going to stop doing good. That's a mistake a lot of investors make. They think, oh, this stock's gone up a lot, so it's going to have to go down. It doesn't have to go down. It can go down next time the market crashes or has a correction or something like that. But just because it's gone up a lot does not mean, look at ELF. Like ELF, I'm sitting on, 2,600% gains? Just because it had been going up a lot does not mean it had to stop going up, right? After it made its first double.
Some of the laggards that you're adding, IBM, Intel, and Tesla. So is this simply you buying them on the dip, or do you have a fundamental reason you're buying? I mean, Tesla's business is under quite a bit of pressure from Chinese EV makers and also just inflation, higher rates.
Well, let's talk about Tesla in specific. It's not a car company. That's my view. That's my perspective. And the data that Elon Musk, one of the most scrutinized companies in the world, has been gathering, if we do see self-driving, fast forward, or any form of acceleration, Tesla's in a position to be the AI leader. But when you look at Intel...
As a Tesla shareholder, I hate this, man. I hate this. Everybody's so afraid to call Tesla an auto company. They think it's like a bearish thing. Tesla's an auto company, but it's also a tech company. You can be both. You're an auto company, but you're also a tech company. That's what Tesla is. It's so ridiculous to say they're not an auto company. And I hear bulls, my fellow Tesla bulls, say this all the time. It is an auto company. What do you think we make money from? Selling pictures? Making TikTok videos? What do you think we're making money from? Where do you think all the revenue comes from and all the profit comes from? It comes from selling cars. We're an auto company. But we also have a tech component to that company, right? That is absolutely unbelievable. And so that's the bottom line in regards to that. It's just ridiculous. It's like Apple saying, we're not a phone company. Yes, you are a freaking phone company. You're a phone company that's also a tech company. You sell other products as well and other services. But at the end of the day, how are you really making your bacon? It's from selling phones, okay? So like that always bothers me. Like when people say, no. Yes, we're a freaking auto company, man. What do you think we're making money from?
Which there's a lot of pressure coming out of China not using their chips anymore. I think a lot of it's been priced in. So we own all 6 of these stocks. Well, all we're doing to the laggards is adding to them, and we're allowing ourselves to add that by reducing the notional exposure to NVIDIA, to Meta, as well as AMD.
Okay, interesting thoughts there. Okay, let's get this next one. Ed Yardeni on why the SP is going to hit 6,000 next year.
Coming out and seeing the potential for a 15% gain in raw materials over the duration of this year, in part because the Fed is going to allow growth to continue. Correct. Mike Wilson over at Morgan Stanley also talking up the likelihood that a commodity-oriented cyclical boom really gets ignited. At what point does this become a problem for the broader market with the idea of inflation coming back?
Well, I'm not that worried about the inflation story because I think certainly on the good side, China is going to continue to export deflation. We continue to see that their producer price index is negative. We continue to see that import prices for the U.S. coming in from China, those are negative on a year-over-year basis. China's in a pretty serious recession.
I've got to be honest with you guys. I've got to push back against the narrative that China's in some horrible place, in some big, huge recession, and things like that, okay? I'm looking at a lot of these companies' earnings. And we had a couple companies that just reported last week. Nike was one of them. Lululemon was another. Guess what some of their strongest markets were, if not their strongest market overall? And you can see the numbers broken down by both those companies. It was China. And then after that, it looked like North America, and it looked like their weakest market was actually Europe. The whole European region has been really bad for a lot of companies out there. So I don't love this narrative that China is like doomed and they're just in this horrible place, because I'm just looking at it and I'm like, it's not coming through in the numbers. In regards to, if you want to speak about Tesla in China, that's competition. The Chinese EV market, unless you're really educated on it, I'm telling you guys, it's so freaking competitive over there, it's ridiculous. I've had several people over time, either in the private stock group or friends of mine, send me pictures when they go over to China of all the different EVs. When they would get a drive somewhere, the EVs they would come pick them up in, they're nice, man. They're nice, and they're sold at ridiculously competitive pricing. And so that's what's going on with Tesla. So don't think China's just in some horrible place because the Chinese market maybe for Tesla's a little weaker. No, that's competition. In regards to Apple, that's competition as well, right? Apple hasn't really been innovating on the phone front for years now in terms of something that the consumer sees as a major advantage, right? And so that's led a lot of people in China to actually just go with Android. And so that's a little food for thought in regards to that. So, you got to look at the numbers, and the numbers out of China. Look at Wynn's numbers out of Macau. Oh my gosh, whoo-wee, it's fun.
They're really in a property depression, kind of similar to what happened in Japan a while ago and in the United States. And it takes years to offset or to come out of that kind of deflationary experience. So I'm not particularly worried about price inflation. I'm more concerned about asset inflation. It's not just the stock market that's on a tear. It's also gold, it's Bitcoin. The spread between high yield corporate bonds and the treasuries is extremely narrow. So that's where the Fed's running a risk here. I think there should be three mandates. If they're going to have a mandate to keep inflation down, price inflation down, keep unemployment rate down, they also have to be concerned about financial stability.
Ed, when you look at the take from Mohamed El-Erian, and he told us on Friday it might not be this pinpoint when it comes to inflation. Maybe the Fed is now targeting a range. And he said last week was a really good moment where potentially you saw that shift. Do you agree? Do you think the Fed is now looking at a range instead of 2%?
Well, it seems more like based on what Powell said, that their target is still 2%. They're not putting that in a range. It's just Powell kept saying over and over again that they're shooting for 2% over time, 2% over time. He said it several times, and that implies that they're willing to lower rates before they actually get to 2%, whereas the message before seemed to be that they're not going to lower rates until they're actually at 2% or so close to it and so comfortable that it's going to stay there that they can go ahead and ease. So I think the message right now is pretty ambiguous, quite honestly. It does kind of make me wonder, what do they know that I don't know? What's the rush to lower rates?
The answer to that, Ed, is maybe nothing, as you know, because they're often surprised by many things. And I just want to know, given everything you've said in the last 5 minutes or so, what are you advocating for in equity markets? What are you advocating for now, from here to year end?
Well, I'm still going to use 5,400. I mean, obviously we were only, 2-3% away from that. But I think it's still a bull market. I think in next year we'll be looking at 6,000, maybe 6,500 by the year after that. So I think we're still in a bull market, and I think you stay invested. And if we get a melt up, we'll have to discuss whether it's time to take some profits before a meltdown. But that's a risk scenario right now. It's not the most likely scenario.
So where does the financial stability point come into play? How concerned are you about that?
Well, I think it is kind of like the 1990s in that regard, but it's not 1999. It's more like 1996. So we may be early on in the financial instability issue here, but things move pretty quickly these days, and everybody knows the history of the stock market. They knows what happened in the 1990s. And if the Fed really, gives us a rate cut before we're expecting it, I think you'll see the market moving a lot higher.
How much are you concerned about bonds waking up to the idea of something of a range, of the idea of stickier inflation?
Right. Well, I think the bond market is happy to see the inflation coming down. And I think the bond market's struggling the way all of us are with the Fed's message. What do they really want to do here? The FOMC statement made it sound like we're going to wait until we have the data that gives us confidence that inflation's coming down. And Powell modified that statement by saying that, things probably aren't going to work out in that direction.
Ed, this just sounds like extend the cycle, which raises a question about the cycle that I'd like your input on. Hear a lot of people come on this program and say we're late cycle. I think Lisa's asked the question a few times. Just how late are we actually, Ed, given the conversation we're having?
Well, I think we've discovered over the past couple of years that history doesn't always repeat itself, but it does rhyme. And, we are, I think, somewhere in the middle of the cycle. I don't think we're late. I think the economy is still showing plenty of signs that inflation is coming down. But, you have to put everything in a global context. It's not just the same old U.S. business cycle. You have to put it in the context of what's going on in China, what's going on in Europe, what's going on in the geopolitics.
Yeah, fair play, Ed. Fair play. The main thing I'll say, is, listen, people can get very, very bullish very, very quickly. They can get very, very bearish very, very, very quickly. It's up for you as an investor to make your weekly, bi-weekly, monthly buys, however you do it, right? Execute on those. Take advantage of stocks that you think are great, attractive opportunities that you're going to be very happy that you bought, 5 years from now. That you're going to look back and be like, dang, I'm glad I bought that stock 5 years ago. You got to do that, right? But stay diversified. We spoke about GVD in this video, growth value dividends. Make sure you're keeping your portfolio overall diversified, right? Across several different industries, across different stocks, across different growth profiles, PE ratios, those sorts of things. And always make sure you keep a little cash around, right? So that way you're kind of ready for whatever happens, right? And if you're a little more advanced, then you can also look into some hedging opportunities as well, okay? All right, guys, hope you enjoyed today's video. Appreciate y'all joining me as always. Thanks so much for being here. If you're looking to join my private stock group and apply to join there, click the pinned comment down there, fill out an application. We see if we can get you in there later this week. You get access to all my course curriculums, all my best courses. You get access to the 6 and 7 figure Discord chat, all that good stuff, okay? Much love and have a great day.